Hey traders, first of all, Happy New Year. Hope you're off to a great start. For today's video, I'm going to do something a bit different. I recently saw a clip on Instagram posted by SMB Capital. I'll play the clip in a moment, but first of all, for those of you who don't know who SMB Capital are, they're a reputable Wall Street prop trading desk. And they have an Instagram page where they share trading concepts, ideas, strategies. And in this particular clip, let's have a look at what they have to say.
A very, very simple but often misunderstood trading opportunity. If the range after 12 o'clock is greater than the range before 12 o'clock, so 9:30 to noon, noon to 4. If the range in the afternoon is greater than the range in the morning, there is a very low likelihood of continuation in the direction of the trend. A very low likelihood of that. It can happen, and when it happens with intense magnitude. But there's a very low likelihood of that happening based on the backtesting we've done.
So there's a few things I want to mention about this. First of all, I was skeptical about this concept purely because as a trader, we often hear things where traders will just rattle off things as if they're fact. And there's no way for us to verify that usually. In this case, we can. And in today's video, I'm going to write a script that analyzes this exact hypothesis, and we can see if this is in fact true. The other thing I want to mention is that in this particular example, this sample size is pitifully small. That's why I was skeptical when I first saw this clip. I thought, we don't even have 100 trades here. 26 examples and 28 examples, that's not a comprehensive statistical data set. That's like the amount of randomness that can occur in a sample size that small negates any findings really from that test. And so I thought, you know what, I'm going to write a script. I'm going to run it through Pine Script on a bunch of stocks, and we'll see if this hypothesis is true. And I didn't expect it to be true. So anyway, let's get into today's script and let's see what we can find by trying to emulate this back test. So let's jump over to the charts and I'll break down exactly what we're trying to analyze here. So what we're looking for is this. First of all, we have a bullish day. Price action opened here in the morning, closed up here on the final bar of the day. So that's a bullish close on the daily chart. The next thing we're looking for is range expansion. So we need to get the highest and lowest point in the afternoon session, which is after 12 p.m. New York time. We measure from the low approximately to the high, gives us 160 points. If this afternoon range is larger in distance than the morning range, so in this case, that would be from this low up to this high, about 74 points. The afternoon range is clearly larger than the morning range. What this means is that tomorrow there should be, theoretically, a very low likelihood of price action closing above this high because we had range expansion in the afternoon on a bullish day. If this was a bearish day, we'd be looking for bearish continuation. We'd be looking for a close below the low. Or I should say we'd be looking for this not to happen. The odds of this happening are a lot lower than price action consolidating or reversing. That's the idea, the concept, the hypothesis. So I've made a script that analyzes this exact pattern in price action, and we can see the numbers. We can see if this is in fact true. So I'll go to Spy, unhide my script. And what you see here, this isn't intended to be a trading script. We don't use this script to trade. This is purely to gather data, to gather statistics. So it's a bit messy. There's a lot of colors going on, but that's okay. What we're concerned with are these numbers up here. And what's happening here? I'll give you an example. This red line is plotting the open to the close. And if it's red, then that means that this day closed bearish. The green background is the morning session. The red background is the afternoon session. So 9:30 a.m. open to 12 noon, and then from 12 noon to the market close. This green line you see here is the morning range. So that's from this high down to this low. And then this red line here is the afternoon range shifted up to the morning range's high, so we can directly compare them. We can actually see at a glance what the size is. So here we can clearly tell the afternoon range is clearly larger than the morning range. and it was a bearish day, so we have bearish range expansion. And so now on the next day's trading, we're expecting price to not close below the previous day's low very often. In this case, it did, and we get this big red bearish continuation label. This red line here is the previous day's low, and we did in fact get a close below that low. So we did have a case of bearish continuation. But what we should see if we go back over historical price action is that about 60% of the time we'll get range expansion, but no continuation. And we have a much larger sample size here of 145 trades instead of 50 or so, like on SMB Capital's video. So there is something here to this concept. And at the end of the video, we'll cycle through a bunch of stocks and we'll see just how often this actually happens. So let's go through the source code really quick for this script. It's a little bit complicated. There's a lot of lines of code here, but the concept's not complicated. But the way I went around doing this is probably a little bit convoluted, but it's the way that made sense to me. There's probably a much better way to do this, but this is how I did it. First of all, we need two sessions. We need the morning session, 9:30 to noon, and noon to 4 p.m. These are our two trading sessions we're going to compare to each other. Then I have a start date, end date filter. I don't use this. I just added this in because it helped with building the script and verifying the numbers. I could test over a shorter range and make sure the numbers added up properly. Next, we have a custom function that just determines if a bar falls within the specified session. So if we pass in one of our sessions, here we're passing in session 1, which is 9:30 to noon. This custom function will return true if that bar falls within this time session. And these numbers here are just days of the week. So we're testing on every single day. You could just put weekdays in here since we're trading or testing the stock market, but whatever, doesn't matter. We're highlighting our sessions. So green, as I said, is the morning session. Red is the afternoon session. That just gives us a visual aid to see what our script is doing. Next, we're getting the higher time frame data. So we're getting yesterday's high and yesterday's low. This allows us to check if we had bearish or bullish continuation, which I already went over what that looks like. Next, we need to detect when the session starts. So when the 9:30 a.m. session starts, we need to detect that so we know that we're now tracking that morning session. And then we have a different Boolean, a true-false value for tracking session 2. Now, the way we detect if a session has just started, one way we can detect this, there's multiple ways to do this, but this is the way I usually use is we just check, was the previous bar not in our trading session? And is the current bar in our trading session? That gives us the crossover. So this first trading bar of 9:30 a.m., the previous bar was not in our session, the 9:30 a.m. bar was. We can use that information in our script to know that this is the bar we need to reset some of our variables. Next up, we have our analysis variables. So this is the number of times each situation occurred. So bullish range expansion, this counts how many times we had a larger range in the afternoon than the morning on a bullish day, and how many times we actually got continuation in the trend. Next, we have our first session variables and second session variables. So in order to draw a lot of this visual stuff, I needed to track a few extra variables purely for drawing purposes. So we're tracking the bar index of the first bar in our morning session so that we can draw this line here that connects the open to the close. That's the only reason we track the index. Same with the second bar index. That's just used to shift our second bar's range size from this bar all the way back to the start of the second session so that we can compare these session sizes, the range sizes side by side. We need to track the opening price and the session low, session high. So this is the morning session's low and high. And I'm just realizing we don't actually need to track the previous session's low and high. That's from earlier iterations of this code. I no longer use this information, so we can get rid of some of this code before we continue. So we're tracking the first session's beginning bar index, the opening price for the day, and the morning session low, the morning session high. The next session needs to track the same beginning bar index for drawing purposes. We need to track the low and the high, and a couple of Boolean values. So we're checking, did we have range expansion on this day in the afternoon? And then we have a Boolean value that checks on the next day if we had trend continuation. And this should actually be called check continuation. That's what we're actually doing with this Boolean. So let me rename this. That will be more intuitive. So this Boolean tracks if we had afternoon range expansion. So in this case, that's this. If that's true, then we do have range expansion and we are checking for continuation. So here we get range expansion, and then up here we have these green squares. That means that we are now tracking bullish continuation. And if this bar, this daily bar, this next day closes higher than the previous day's high, then we did in fact have bullish trend continuation after range expansion. That's what these two variables here, these two flags, track for us. Next, we have our analysis variables, and I can get rid of a couple of those as well. So all we really need is to check, was yesterday bullish or bearish? If it's true, then it was bullish. If it's false, then it was bearish. And are we monitoring the first session currently? If this is true, then we're tracking the first session's high and low. If it's false, then we're tracking the second session's high and low. So next up is our first session's analysis. So first we need to detect the start of day's first session. That's this Boolean value here, which we already went over. Start session 1. If that is true, then we check, did we have a bullish close? So remember, the start of session 1 is on the first bar of the next day. So close with a historical operator of 1 will reference the close of the bar, 1 bar back from the first bar of the next day. That gives us yesterday's closing price. So if yesterday's closing price is greater than yesterday's opening price, then we had a bullish day. Then we draw a line between the open and the close, and we color the line based on whether it was a bullish or bearish day. Then we check if the afternoon session's high and range size, so this gets our range size in points. If this range is greater than the range in the morning, then we did have range expansion, so that's set to true. And we plot a label, this blue label, that just signifies that we had range expansion on that day. This afternoon session was larger than the morning. Range expansion label is drawn. If this is not true, if we did not get range expansion, then we set range expansion to false, and we just wait to see how the next day plays out. So at the end of each day, or more accurately at the beginning on the first bar of a new day, we check if yesterday had range expansion. Ideally, we would check this on the last bar of the trading session, but it's a lot easier to detect this first bar of a new day because we can have different trading hours on some days. Some days the market closes sooner than other days, and we have holidays, etc. that can throw things off. So by waiting for the start of a new day, we always get the closing price of yesterday accurately. So after we check if we had range expansion, we save the first bar's index, and we reset our session low and session high, and we set our flag for monitoring the first session so that we can track our morning session's low and high as it unfolds. And we save today's opening price. So remember, this code's being executed on the very first bar of a new day. So if we save the open of that bar, we're getting today's open price. Next up, we check, did we have range expansion yesterday? If so, check if we continued in trend. So if check continuation is true, then we check, was yesterday bullish? If so, then we check if yesterday's closing price was greater than the day before's high. That gives us trend continuation. So in the case of a bullish trade, we're looking for price to close. Here we just barely get trend continuation. See, this closing price is above this green line. The green line is yesterday's high. We barely got bullish continuation there. So yesterday's close was greater than yesterday's high. We increment or add 1 to our bullish expansion count. So that's this counter here. We add 1 to this number. We draw a line signifying yesterday's high, so we can see visually if price closed above yesterday's high. And we color that line based on where the price actually closed above or below it. If price closed above it, the line's green. If it closed below it, it's gray. And for bearish continuation, the line is red if we got bearish continuation, or it's gray if we didn't. So just another way to visually analyze what our script is doing. So here we had bullish range expansion on the previous day, but price closed below our high for that day. So remember, this is a whole new day. We're analyzing what happened on this day compared to yesterday. We're tracking yesterday's high. We did not get a close above that high, so we did not get bullish continuation on this day. So that's what all this code here does. And then we do the same thing for the bearish side. So check continuation will be set to true if we had range expansion. Then we need to check if that day that created the range expansion was a bullish or bearish day. Then we need to check if today's closing price continued in the trend of the day that created the range expansion. It's a bit hard to wrap our heads around. I know if you're anything like me, your head's probably spinning right now. It took me a lot longer than it should have to even write this script, because just wrapping your head around all the different things we're tracking in Pine Script is a little bit tricky. But anyway, the concept is simple, as I said. All this code is doing is tracking range expansion and then seeing if we had trend continuation on that next day. So if this line's green and we got bullish range expansion, we want to see the next day close above this high. Anyway, moving on, we then reset our check continuation variable and we save whether or not today was a bullish or bearish day. Next, we track the first session's range. So this is very simple. All we're doing is saying, are we tracking the first session? If so, our chart will be green. If the chart is green, we are just saving the highest and lowest value throughout that session. And then we do the same thing further down for the second session. So if we're not monitoring the first session, the morning session, then we must be monitoring the second session. And then we just track that session's high and low so that we can get our range sizes when the next day starts. But finally, the last thing we need to do is detect the start of the day's second session, the afternoon session. We need to save the previously monitored session's range. And actually, we can get rid of step 2. That's not accurate. All we are doing is detecting the start of the second day's range and resetting the second range's variables to NA, so the session low and session high. And then we're saving the session bar index for drawing purposes. And then we're tracking if we need to check for continuation on when this second session ends. So at the end of this red period of time, that's when we track if we had continuation. And that's it for this script. All the rest of this code is just drawing code. So we have the analysis of our range expansion information. So we have the total expansion range count, which just adds up the bullish days with expansion and the bearish days with expansion. And then we calculate the total expansion chance. So we combine these two metrics to get this percentage chance. And then we calculate the bearish and bullish odds individually. Then we have our debug data window plots. So this is purely for tracking what the script is doing. All of these plots here draw exclusively into this debug window where we can track the different metrics. So I can hover my mouse over here, for example, and we can see the numbers change. We can see that on this green bar, our total bullish range expansion count goes up, but our bullish range continuation counter does not go up because we did not get continuation. And so this is just a way to debug our script and just see what it's doing on a bar by bar basis. And then down here we have our table. This is the code that displays all of this information up here into our table. And that is the code for this script. I know it's a bit convoluted. I probably didn't do the best job of explaining this because it's quite a complicated thing to do in Pine Script. The concept is simple, but the code has a lot of overlapping analysis over 2 different sessions and then the previous day's price action. So it's a bit tricky to write this in a way that's intuitive to understand. But as always, the source code will be below in the pinned comment below. So if you want to better understand the script, go and copy the source code into your editor and play around with it. But anyway, let's wrap up the video by having a quick look at how this performs in practice. So what I'm going to do here, just to save time, ideally what we would do is just go through a bunch of markets and track the percentage chance properly. But what I'm going to do, just to get a rough idea of how accurate this hypothesis is, I'm going to cycle through 30 or 40, maybe 50 of these stocks. And I'll write on a notepad on my desk, 2 columns, any market or stock that has a total continuation chance after range expansion of 50% or higher will go in the right column. Any markets that are below 50% will go in the left column. And we'll just see out of curiosity how many markets out of that sample size do in fact continue in trend after experiencing afternoon range expansion and how many didn't. So I'll fast forward through this and give you my findings at the end. All right, so I just went through 100 markets here, and this is an outdated, a couple of months out of date, but this list here tracks the S&P 500 constituents, so the members of the S&P 500. So I just went over them, whatever order this list is in, I don't know. It's not very important. But out of 100 stocks, we had 12 stocks have a 50% or higher chance of continuation in the trend after range expansion in the afternoon. So I think it's safe to say that this hypothesis is true. Ideally, I'd like to do the full 500 would be a great sample size, but 100 stocks, 12 of them had a chance of 50% or higher, and 2 of them were right on 50%, which is obviously neutral. So maybe we shouldn't even include those 2. So in that case, we only had 10 stocks with a greater than 50% chance of continuing in the trend after range expansion in the afternoon. So in other words, when a stock trades more distance in the afternoon than it did in the morning, there is a statistically significant chance that it will not continue in that trend the next day. It will not close higher than its previous day's high. That's useful information to know. I'm sure you will all agree. If you're a day trader in particular, like the guys at SMB Capital tend to be, it's pretty useful to know that if this happens, you've got a better chance of trading against momentum the next day. You've got a better chance of price moving in your favor if you trade against momentum after afternoon range expansion on that next day. That's pretty useful information to know. It's not obviously not going to work all the time. A lot of these numbers were close to 40% on most stocks. So there's still a 40% chance that the market will close higher. But just in general, good to know that this hypothesis is true. Basically, this lesson was just to show you guys the power of validating things you hear from traders, especially if you're skeptical. When I first heard this, looking at their sample size, I was not convinced that this was true, but now I am. And now I personally don't day trade US stocks because trading starts at midnight for me where I live. So I just don't trade the US market on an intraday basis. I do on a daily end of day basis. But anyway, that's outside of today's lesson scope. But for those of you who do trade the US market, especially intraday, keep this in mind. It might be worth downloading the script, the source code, and adapting it so that you can be aware when a market had this afternoon range expansion on the previous day, and you know that there's a statistically significant chance that price will not continue in yesterday's trend. It will not close higher than yesterday's high in the case of bullish range expansion. I thought this was interesting. Hopefully you guys did too. I'll speak with you in the next video. Best of luck with your trading and your coding. Take care.
A very, very simple but often misunderstood trading opportunity. If the range after 12 o'clock is greater than the range before 12 o'clock, so 9:30 to noon, noon to 4. If the range in the afternoon is greater than the range in the morning, there is a very low likelihood of continuation in the direction of the trend. A very low likelihood of that. It can happen, and when it happens with intense magnitude. But there's a very low likelihood of that happening based on the backtesting we've done.